Okay. So this one is the real deal of the discounted cash flow calculator. So this one is used actually the same thing that we use the IRR and PV. However, this one really calculates the intrinsic value of companies. So we are using DCF still, but we want to know the intrinsic value of companies based on the future cash flow. Now, of course, there are given that you have to, to fill up here. First, yung initial FCF would be, by the way, this is from the Indians. That's why, we're using their currency. So, take 3 years average of net cash flow from operating activities minus the capex. So, we have to average. The idea here is that you have an initial FCF for the first years. I think that's what they will do. Calculate. Well, they will project, the first 3 years. And then the first year, sorry, and then they will look at the growth rate given here. You can customize it, and then they will look at the growth rate for the 6 to 10 years. And the terminal rate will be after 10 years. It'll flatten out. Like usually, the growth rate for the first 1 to 5 year would be higher than the 6 to 10 years. Pwede naman, no? It can be that 1 to 5 years is higher than 6 to 10 years. And then this one is usually lower, like 1%. Then this is the market capitalization. I think this year, determined the current share price. So that's now they also have like a margin of safety 10 to 30%, depending on how sure are you, how aggressive you think you are, how conservative you estimate its future company. So the good thing about this is that when the initial FCF would be, um, you don't have forecast about that. So what you will do is just base it on the last 3 years of the company. Okay, so net cash flow from operating activities minus the capex. So this is the free cash. All of these are given, but in the real deal, to calculate it out. Okay, so let's pretend all the numbers are good here. So net cash flow from operating activities, so this is just average minus the capex. Let's say this should be so let's say that this is in millions. So let's say it's 12,234. So that means 12.234 billions. This is the free cash flow. Okay, 145. So this will now be 1.4 billion. And then the discount rate would be just the uh, required return. Okay, so maybe 6.25, 6.75%. So we want it to be bigger than 10-year bond rate. And then let's say that the growth rate for the first 5 years would be high. And then 6 to 10 years, it will be, and then the terminal rate, it will be something 1.5%. Okay. Let's say also, price to cash flow. So the market cap would be around, say, 20.560 billion. Okay. Current share price is 20.56. It's just, yeah, million shares. Then we have the net debt of, let's say, margin of safety. We have a margin of safety of 15%. 15%. is again we'll just calculate. The DCF would be $64.58. So in this case, it's rupee. And then if you deduct the margin of safety, so you're just like saying, okay, you have to buy the stock at 54.89. I mean, that's the strike price. Although currently the share price is 20.56. So it's like saying, because of this growth rate, 15% growth rate in the first 5 years, and then growth rate of 6 to 10 years of 10%, and then terminal rate is 1.5%. Uh, maybe 15 to 30 years or something like that. Then you can actually buy this stock at $54.89. But now it's only at 20.56. So it's I think this is a good calculator. I bookmarked it. My browser, it is a different browser. Okay, so let's say what will be the effect should I increase the. So let's say the debt is not 3454, but 5432. You will see that it becomes, because the effect of the debt put a toll on the price of the company. Also, if you put the terminal rate at only 1%, okay, maybe the growth rate is not 1 rate, but rather, and the growth rate in the first 5 years would be just 1 rate. You will see the so it's around 86. So that means if the stock is trading now at 20.56, you cannot let it go beyond this fair market value. It's risky, riskier for you. Even in solution for the things that you need. So this is very, I think this is very important, very useful. This is useful for you to calculate your. You have to have all of this in. So initial FCF would be given to you using the annual report of the company. If you don't have 3 years, maybe you just use the last 2 years. It's there even. Just that you have to deduct the capital because that's going to be. This one will change depending on the investor's rate. So this is the 6.75 because that is the return rate of the 10-year bond rate. So that is actually our risk rate. Then the growth rate will also change depending on what you think will be the growth rate of the company. You can customize it even. So let's say you customize it to 17%. So calculate. Now it becomes higher again because we've changed the growth rate in the first 5 years at 17%. So what is the meaning of this? The meaning of this is that the free cash flow every year is expected to increase by 17% for the first 5 years. So 1453 multiplied by 1.17, that would be for the second year, for the first year, for the second year, for the third year, for the fourth year, for the fifth year. So this is quite high. Although I must tell you that Apple, some has its surge of 65% annual growth rate in the 10 years. I think from 2000, something, and then they released it. I don't know for is to say to the 17 to 18. So they have done that. So it's possible. But if you want to make it realistic, I would suggest just a moderate rate here, and then growth rate of 6 to 10 years, make it low because you don't know what will happen in the year 6 to 10. So it will make your calculation conservative. And then this margin of safety, if you want, make it 30%, something like that. So that, see, your fair value now is only 2650. So that means you are able to enter lower. So if you enter the 20.56, you are expecting the price to reach about 37.86 in the next 2 years. So anyway, all of these will be clear when we get to the financial analysis on listed companies or the stock.